right? So you want to understand how online casinos actually make money, or at the very least, you want to know what actually happens after you deposit your money and start gambling. First of all, a legitimate online casino requires anywhere from $50 million to $150 million in initial capital just to launch legally. That's more than the annual budget of some small nations. But here's the strange part. Casino operating the platform usually doesn't own the technology, and more importantly, how does owning a $100 million gambling platform actually make you money? Because in online gambling, ownership is a completely different business than operation, and it's far riskier than it looks. When people hear online casino, they imagine a simple website where you click buttons and gamble. But a modern online casino is essentially a flying, self-sustaining financial machine. It consists of thousands of individual software components, sophisticated encryption and security systems, payment processing networks, and regulatory compliance frameworks, all integrated into a structure designed to extract maximum value from players while operating in legal gray zones across multiple jurisdictions. It has gaming servers capable of processing millions of transactions per second, all built for an expected operational life of 5 to 10 years before becoming obsolete or facing regulatory collapse. Take a large online casino ordered from a major software provider like Playtech or Microgaming, but the prices are not random. It all depends on the licensing jurisdiction you choose, the type of games you want in your platform, the payment processing infrastructure you select, and the production capacity of the software provider you're ordering from. And then there's global gambling demand, the ultimate wild card that shapes everything. Casino valuations don't behave like real estate. They behave like volatile stocks on steroids. When gambling is legal and expanding, casino valuations surge dramatically. During regulatory crackdowns, they collapse with staggering speed. For example, when the United States banned online gambling in 2006, some casino companies lost 80% of their value in a single year. Casinos that cost $100 million to build were suddenly worth $20 million before they even generated significant revenue, simply because demand had evaporated overnight in the largest market in the world. In global online gambling, there are three main players: the software providers, the casino operators, and the casino owners. And almost always they're completely separate companies with diverging interests. For example, a global casino operator like PokerStars or Bet365 operates hundreds of different casino brands and platforms. You see their logos on websites and advertisements, but they do not own all of those casinos. In fact, many operators prefer to own as few as possible because ownership is a capital-intensive nightmare. Many are simply licensed from distant owners you'll never meet. So who holds the deed to that $100 million piece of software engineering? It might be a casino holding company like GVC Holdings or Flutter Entertainment, which owns thousands of casino brands across their portfolio. It could be a wealthy individual from Eastern Europe or Asia who views casino ownership as a long-term investment and status symbol. It might be a private equity firm operating out of a sleek office in London or New York. It might be a cryptocurrency fund that owns casinos purely as diversification assets on their balance sheets. These owners don't care about player experience. They don't care about game fairness or customer satisfaction. They care about one thing: profit extraction. Owning an online casino is basically a massive high-stakes financial extraction business. To make your money back, you have to extract value from players at rates that justify the staggering capital investment. There are three main revenue models, each with a vastly different risk profile and income structure. Number one is the house edge model, a safety bet for owners. The casino operates games with built-in mathematical advantages. Slot machines return 92 to 98% of wagers to players, meaning the casino keeps 2 to 8%. Roulette has a house edge of 2.7% on European wheels. Blackjack has a house edge of 0.5 to 1%. These aren't random. They're precisely calculated to ensure the casino profits over time. If rates are high when you launch, you lock in strong guaranteed return. But if regulations force you to increase player protections, your house edge shrinks and profitability collapses. Number two is the player acquisition model. The casino acquires players through massive marketing spend, bonuses, and affiliate commissions. A single player acquisition might cost $50 to $200, but the lifetime value of a player is calculated ruthlessly. If a player deposits $1,000 and the house edge is 4%, the casino expects to profit $40 from that player. But most players lose far more than their initial deposit because they chase losses. The average player lifetime value is $500 to $2,000 in profit for the casino. The economics are so predictable that casinos can model player cohorts with precision. Number three is the data monetization model. The casino collects massive amounts of data on every player. betting patterns, win-loss history, time spent gambling, devices used, geographic location, and behavioral patterns. This data is worth billions. Casinos sell it to marketing firms, other gambling companies, and financial institutions. They use it to build psychological profiles of players and target them with personalized offers designed to maximize lifetime value. The data harvesting is so sophisticated that casinos can predict player behavior with stunning accuracy. This is where the system reveals its true nature with brutal clarity. When regulations tighten in major markets, casinos face an existential crisis. Demand for gambling doesn't disappear, but profitability collapses as compliance costs surge and player acquisition becomes more expensive. Casinos that were generating $10 million per month in profit suddenly face $5 million in monthly compliance costs. They desperately cut costs, reduce player protections, or relocate to less regulated jurisdictions. Suddenly, casino owners found themselves holding platforms with no one to gamble on them profitably. Casinos that were generating $5 million per month in profit were now generating $1 million. Owners faced a difficult choice: accept pennies on the dollar to sell the casino or hold out and hope regulations relaxed. Many chose wrong and went bankrupt themselves. The separation of ownership and operation spreads risk, but it also creates contagion across the entire financial system. When operators fail, owners suffer catastrophic losses that cascade through their portfolios. How do these owners afford the casinos in the first place? Because almost no one pays cash. The typical financial structure is 20 to 30% equity and 70 to 80% debt. Specialized gaming finance companies provide colossal loans secured by the casino's future revenue as collateral. To protect themselves from catastrophic losses, owners use a legal shield called a special purpose vehicle. If a wealthy investor owns 50 casinos, they do not own them under one massive corporate umbrella. Instead, they create 50 separate shell companies, often registered in tax havens like the Cayman Islands, Luxembourg, or Ireland. One company, one casino. Why? Because if a casino faces regulatory collapse or becomes worthless, the rest of the portfolio is protected from creditors. There's a massive problem lurking here. Let's say you borrow $80 million to buy a $100 million casino. A year later, regulations tighten, and the casino's valuation drops to $30 million. You're now underwater on your loan. Collateral is worth less than the debt. The bank panics and demands cash immediately. If you can't pay, they seize the casino. Online gambling history is littered with the corpses of over-leveraged companies that made exactly this mistake. Let's assume you managed the debt perfectly and never faced a margin call. You still face another enemy that's far more insidious: regulations. A casino platform lasts 5 to 10 years before becoming obsolete. But regulatory rules are currently turning the industry upside down with alarming speed. Push to protect vulnerable players means sudden mandates for new responsible gambling features, stricter identity verification, and enhanced compliance systems, costing millions per casino. Furthermore, what happens if you build a casino today that operates in 50 jurisdictions to find out in 5 years that the global standard is stricter player protection? Your casino becomes a stranded asset overnight. It's too expensive to operate, illegal in certain jurisdictions, and impossible to sell. Its $100 million drops to near zero. Owners are constantly gambling on regulatory trends, player protection standards, and geopolitical shifts. Online gambling rewards patience and heavily punishes overconfidence. Because of this volatility, casinos are traded just like volatile commodities on global markets. A casino generating $5 million per month in profit might be worth $500 million in a boom because investors want casinos today, or drop to $100 million in a crash. Some owners don't even intend to operate the casino for its full lifespan. They speculate relentlessly, buy low, acquire players aggressively, sell high, and when a casino finally reaches the end of its profitable life, it still holds some value. It might be sold to a competitor who consolidates it into a larger platform. The owner receives payment based on the remaining player database and brand value, typically 10 to 20% of the original purchase price. It's a pittance compared to the original $100 million purchase price, but it's better than nothing. The casino that once generated millions in monthly profit is reduced to a brand name and a player list. So why does this chaotic system work at all? For an operator like Bet365, owning every casino platform they operate is incredibly capital-intensive and debt-loaded. If global gambling demand slows down, an operator with 50 owned casinos still has to pay 50 mortgages, even if they're generating minimal profit. Licensing provides maximum flexibility. If demand drops, the operator simply lets their licenses expire and hands the casinos back to the owner. The operator stays lean, the owner takes the financial hit. This separation of ownership and operations spreads risk across the global financial system. When an operator goes bankrupt, the casinos don't disappear. The owners simply license them to a competitor. The companies may die, but the casinos keep operating. The ecosystem adapts because casinos are valuable regardless of who operates them. But here's where it gets truly rigged and unfair to casino owners. Operators operate on razor-thin margins, typically 5 to 15% profit on revenues. Player acquisition costs represent 20 to 40% of operating expenses. When competition intensifies, operators hemorrhage money and cut routes. When competition eases, they profit and expand aggressively. But casino owners face a completely different problem. If competition intensifies, operators reduce licensing fees and return casinos. If competition eases, operators demand more casinos, driving up licensing rates. Owners are constantly hedging against competitive volatility, a variable completely outside their control. A sudden regulatory change that increases compliance costs can bankrupt both operators and casino owners simultaneously. The software provider industry itself is rigged by design. Only a handful of companies build casino software: Playtech, Microgaming, and a few others. They control the entire supply chain completely. When you order a casino platform, you're not just buying software. You're entering a multi-year contract with development timelines that stretch years into the future. Prices fluctuate based on development costs, geopolitical tensions, and demand cycles. You have no alternatives, no negotiating power, and you're locked into whatever terms the software providers dictate. During regulatory crackdowns, casinos that had ordered platforms for $50 million suddenly found them worth $10 million before launch. They were forced to either accept massive losses or cancel orders and face severe penalties. The software provider oligopoly means you have no escape. Behind every online casino you gamble on is a complex web of financial players you'll never see or know about. There are casino holding companies that own hundreds of brands. There are investment funds that buy casinos as diversification. There are private equity firms that own casinos as long-term assets. There are wealthy individuals from Eastern Europe and Asia who view casino ownership as a status symbol and investment vehicle. There are even casino brokers who buy and sell casinos like commodities, taking a cut on every transaction. This hidden financial ecosystem is worth hundreds of billions of dollars, yet it operates almost entirely outside public awareness and scrutiny. Casino ownership is increasingly entangled with geopolitics in dangerous ways. When countries impose gambling restrictions, Western casinos lose access to entire markets. When the United States tightened online gambling regulations, casinos lost billions in potential revenue. When China banned cryptocurrency, crypto casinos lost their primary payment method. When the UK implemented stricter regulations, casinos had to implement expensive new compliance systems. Casinos became weapons in geopolitical conflicts, and owners found their assets devalued or worthless. Geopolitical tensions can instantly destroy the value of casino portfolios, a risk that's impossible to fully hedge against. Owners are at the mercy of government decisions they can't control. The licensing agreements themselves are masterpieces of financial engineering designed to protect operators at the expense of casino owners. Operators negotiate clauses that allow them to terminate licenses if they become uneconomical. They negotiate revenue sharing that shifts the burden of player acquisition costs onto owners. They negotiate residual value guarantees that protect them if casino values collapse unexpectedly. Owners accept these terms because they're betting on long-term appreciation and licensing income, but they're essentially betting against themselves. They're accepting downside risk in exchange for modest upside returns. Consider the economics of a typical casino license carefully. An owner buys a casino platform for $100 million with $30 million of equity and $70 million of bank financing. They license it to an operator for $2 million per month. After 10 years, they've collected $240 million in licensing fees. They've paid off the $70 million loan plus interest, roughly $100 million total. They've paid compliance costs, software updates, and other expenses, roughly $50 million total. They've collected $240 million in licensing fees. Their net return is 240 minus 100 minus 50 equals $90 million. They've made money. But wait, they still own the casino. If it's worth $50 million at the end of the license, they profit $140 million. If it's worth $10 million, they profit $40 million. If it's worth zero, they break even. The entire return depends on the residual value of the casino at the end of the license, a variable that depends on regulations, technology, and geopolitics. It's a bet, not a sound investment. This is why casino owners are constantly monitoring regulatory changes, player acquisition trends, and competitive dynamics like hawks. They're not passive investors, they're active traders trying to time the market perfectly. Some owners buy casinos during a regulatory crackdown for $20 million, license them out and sell them during a boom for $80 million. The difference, minus financing costs, is profit. Others buy at the peak, license them out, and watch regulations tighten, losing everything. The difference between success and bankruptcy is often just timing and luck. It's a casino for sophisticated players with billions at stake. The secondary market for struggling casinos is where the true desperation shows clearly. When a casino reaches 5 to 7 years old, it becomes harder to license to major operators because they prefer newer platforms with better technology. Older casinos are sold to smaller operators, cryptocurrency platforms, or companies in less regulated jurisdictions at steep discounts. A casino that once licensed for $2 million per month might be sold for $10 million to a smaller operator. The owner takes a massive loss, but at least they get cash and eliminate the risk of the casino becoming completely worthless. The secondary market is a dumping ground for casinos that owners can no longer profitably operate. And then there's the ultimate endgame, casino shutdown and asset liquidation. When a casino reaches the end of its profitable life, it's shut down, the technology becomes obsolete, the player database becomes worthless, the brand becomes toxic. The owner receives payment based on the remaining value of the platform, typically 5 to 10% of the original purchase price. It's a pittance compared to the original $100 million purchase price. But it's better than nothing. Casino that once generated millions in monthly profit is reduced to nothing. The online gambling industry faces an existential transition that threatens casino values everywhere. Stricter regulations, responsible gambling mandates, and player protection requirements are coming, but the timeline is profoundly uncertain. Casino owners are gambling on which regulations will stick and which will be delayed. An owner who invests in a casino designed for strict regulations might find the regulations delayed by a decade, leaving them with over-compliant assets. An owner who bets on loose regulations might find their casino banned from major markets within 5 years. This regulatory uncertainty adds another layer of risk to an already precarious business. Owning a $100 million casino isn't just about managing debt and predicting demand cycles. It means betting on the future of gambling regulation itself. Not all casinos make it to their 10-year lifespan in active operation. Some are retired early due to regulatory pressure, technological obsolescence, or simply becoming unprofitable. These casinos enter the secondary market where they're sold at steep discounts to smaller operators or cryptocurrency platforms. A casino that once served millions of players might be converted to a niche platform and operated until it's literally generating no profit. The secondary market is where casinos go to die slowly, generating minimal returns for owners, but keeping the asset from total loss. Eventually, even these casinos reach the end of their lives and are shut down completely. Regulatory changes are reshaping the entire industry with unprecedented speed and severity. New mandates for player protection, responsible gambling features, and compliance standards force expensive retrofits on casinos. Casino designed for loose regulations might become illegal to operate if the industry shifts to stricter standards. A platform certified for one region's market might be banned in another due to player protection regulations. Owners are constantly gambling on which regulations will stick, which will be delayed, and which will render their assets worthless. A $100 million casino can become a stranded asset overnight if regulations shift unexpectedly. The entire system is designed to extract value from casino owners and transfer it to operators and software providers efficiently. Operators get to use expensive platforms without owning them, maintaining flexibility and minimizing capital requirements. Software providers get guaranteed demand and long-term contracts. Banks get interest payments and collateral. Brokers get transaction fees on every deal. Casino owners get the residual risk and the hope that they time the market correctly. It's a rigged game where the odds are stacked against ownership, yet the system persists because it works for everyone except owners. When an operator goes bankrupt, it returns its licensed casinos to owners without hesitation. During the COVID-19 pandemic, some operators faced existential crises as player acquisition costs surged and compliance requirements increased. Suddenly, hundreds of licensed casinos flooded back to owners who had no way to redeploy them. Casinos sat idle, burning money through maintenance costs while generating zero revenue. Owners faced a choice: accept pennies on the dollar to get the casinos off their books, or hold out and hope demand returned. Many chose wrong and went bankrupt themselves. The separation of ownership and operations spreads risk, but it also creates contagion. When operators fail, Owners suffer catastrophic losses that ripple through their entire portfolios. Player acquisition cost volatility is the invisible killer of casino owner profitability. Operators operate on razor-thin margins, typically 5 to 15% profit. Player acquisition costs represent 20 to 40% of operating expenses. When competition intensifies, operators hemorrhage money and cut licensing fees. When competition eases, they profit and expand. But casino owners face the inverse problem. If competition intensifies, operators reduce licensing fees and return casinos. If competition eases, operators demand more casinos, driving up licensing rates. Owners are constantly hedging against competitive volatility, a variable completely outside their control. A sudden regulatory change that increases compliance costs can bankrupt both operators and casino owners simultaneously. Consider the impact of a single regulatory event. When the UK implemented stricter player protection regulations, compliance costs surged. Operators faced losses, casino owners faced reduced licensing income. When the United States tightened online gambling regulations, entire markets closed. Casinos lost access to millions of players. Casino owners faced reduced capacity utilization. Every regulatory change sends shockwaves through the entire gambling industry, hitting owners hardest because they have no control over operations. They just collect licensing fees and hope the market stays stable. Casino holding companies themselves are complex financial structures with their own risks. They manage thousands of casinos worth hundreds of billions of dollars. They finance this with debt markets. If debt becomes expensive, their returns shrink. If credit dries up during a financial crisis, they can't finance new casino purchases. If their own credit rating drops, their cost of capital increases. Casino holding companies are exposed to financial market risks that have nothing to do with gambling itself. Credit crisis in London or New York can bankrupt casino owners in Singapore. Concept of stranded assets haunts every casino owner. Technology changes, regulations shift, and suddenly an asset that was worth hundreds of millions becomes worthless. A casino optimized for loose regulations becomes obsolete as the industry shifts to stricter standards. Platform designed for traditional payment processing becomes a liability if cryptocurrency becomes mandatory. Owners are constantly making bets on regulatory adoption, technology standards, and competitive directions. Wrong bets destroy wealth, right bets create it. Some casino owners don't even intend to hold casinos for their full lifespan. They speculate ruthlessly, buy a struggling casino during a regulatory crackdown for $20 million, license it out aggressively, and sell it during a boom for $80 million. The difference, minus financing costs, is profit, but timing is everything. Buy at the peak and you're underwater immediately. Sell at the bottom and you lock in losses. It's a high-stakes game where milliseconds of timing can determine success or bankruptcy. Most speculative owners lose. A few win generational wealth. The secondary market for niche casinos is particularly volatile. As the industry consolidates, smaller casinos flood the secondary market. They're sold to cryptocurrency platforms, smaller operators, or companies in less regulated jurisdictions. Casino that once served millions of players might be sold for $5 million to a niche operator. The original owner takes a massive loss, but that casino still generates some returns before being shut down completely. The secondary market extends the economic life of casinos, but at deeply discounted rates. Casino financing is the lifeblood of casino ownership, and it's incredibly complex. Gaming finance companies provide loans with complex covenants and restrictions. The loan amount depends on the casino's age, technology, and earning potential. Interest rates depend on creditworthiness, market conditions, and regulatory forecasts. If the bank believes gambling demand will decline, they demand higher interest rates. If they believe it will surge, they offer lower rates. Owners are gambling against banks on the direction of gambling demand. Most owners guess wrong and overpay for financing. The insurance markets for casinos are equally complex. A casino worth $100 million needs insurance against cyber attacks, fraud, regulatory penalties, and liability claims. Insurance premiums are based on the casino's security infrastructure, compliance history, and regulatory exposure. Operating in jurisdictions with strict regulations costs more to insure. Operating in jurisdictions with loose regulations costs less to insure but carries higher regulatory risk. Insurance is another cost that directly impacts returns. Higher insurance costs mean lower profitability. Casino utilization rates directly determine profitability. If a casino attracts 100,000 active players, it generates more licensing income than if it attracts 50,000 players. Operators optimize marketing to maximize utilization. But global gambling demand fluctuates seasonally and cyclically. Summer gambling booms, winter gambling shrinks. Economic crises reduce gambling. Regulatory changes reduce gambling. Technological disruptions reduce gambling. Utilization rates swing wildly, and casino owners suffer from low utilization. A casino that should generate $2 million per month but only attracts half the players generates just $1 million. The mortgage doesn't change. The entire system rewards operators and software providers while punishing owners. It's designed this way intentionally. Software providers want predictable demand and long contract terms. Operators want flexibility and minimal capital requirements. Banks want collateral and interest payments. Everyone else absorbs the risk. Casino owners are the margin providers who enable the system to function. Without owners willing to hold casinos and accept the risk, operators would have to own everything and capital requirements would skyrocket. The system distributes risk in a way that incentivizes casino ownership despite its precarious nature. If you want to understand modern gambling empires, you have to understand casino ownership. You have to understand how Eastern European oligarchs control 20% of the world's online casinos. You have to understand how private equity firms pool money from ordinary investors to buy casinos for financial returns. You have to understand how cryptocurrency funds use casinos as diversification assets. You have to understand that the casino you're gambling on is ultimately owned by someone trying to generate returns by betting on regulations, technology, and player behavior. The system is rigged, but it's also efficient. It allows capital to flow to where it's most productive. The truth about online casino economics is far stranger than fiction. If you found this deep dive valuable, please subscribe to the channel and hit the notification bell so you never miss another investigation into how global financial systems actually work. Share your thoughts about casino ownership in the comments below, and thanks for watching.